first of all, thanks so much for making time to join us on the podcast. I'm very excited about this conversation for various selfish personal reasons, which I'll discuss with you as we go along. But before we get into all of the things we want to talk about as far as real estate investments, give us a thumbnail version of your career, maybe just a little bit of a background, and I'd love to spend some time then talking about what you're currently building.
My name is Amanda Han, and my firm is called Keystone CPA, and we work with real estate investors nationwide on how to use real estate to save on taxes legally. And my background, actually, I started my career as a CPA at Deloitte & Touche. I think now it's just called Deloitte, one of the big four accounting firms. And I happened to end up in the real estate specialty group. So back then I worked with, the very large real estate investment companies, developers, and things like that. And over the years, my husband, Matt, and I just decided that we wanted to also invest in real estate ourselves as a wealth building tool, because we saw the power of real estate investing, the power of tax savings through real estate. So that's what really prompted us to become investors ourselves. And once we did that, we saw that there was a need for the average investor to have access to some of these strategies that were traditionally for people who had, very large portfolios. And that's kind of how the start of Keystone CPA, kind of got started, is trying to bring those more advanced strategies for the large investment firms down to everyday investors like you and I.
Well, that's super exciting, and thank you for sharing that background. Very impressive how you also spent some time in the corporate sector. You kind of understood and learned all of the the intricacies that go along with just the overall corporate world when it comes to tax savings and the advisory from that standpoint, and then transition that into, sounds like, your own business. Tell us a little bit more about that transition, because I've gone through the very similar journey, but more on the technical side. I've been in corporate America, Fortune 500, as a technology executive for many years. And recently, in the past several years, I've transitioned fully into just that entrepreneurial space as a real estate and technology investor. So I know how hard it is, but maybe talk a little bit about that journey. How, basically, what was the motivation behind that, and what are you currently experiencing as you launch your own company?
Yeah, it's interesting. So we launched our firm back in 2010, which, for people who were around back then, it was kind of, the bottom of the market. So quite scary to leave a really established, well-paying job, like you said, in corporate America, to start your own firm, specializing in real estate investors, knowing that real estate was, on the downward trend. And yeah, I think just with anything, a big life change like that came with a lot of unexpected hurdles. Back when I was in corporate, there's, you have departments that did stuff for you, right? Someone would, like, there's a mail department that dealt with all the mail. There's an IT department, kind of like what you did, John, that dealt with, like all the tech stuff. And starting our own business was kind of like, I'm the mail person. We gotta send stuff out. That's me. We gotta get supplies. That's my husband. We're going to Costco. So those were kind of like unexpected, like I start to have to wear multiple hats. But for us, it's really been rewarding just being able to work with everyday investors. In the corporate world, when you save people a lot of money, you don't really see the impact, right? Because it's going to thousands of shareholders or the CEOs, and they don't really care too much. But for us, we're working with, John and Mary, and we're able to save them, 10, 30, 50, $100,000 in taxes. We see the impact of them being able to use that money for investments or for family, for their kids, for education. So that part of it is really rewarding. I definitely say harder to be an entrepreneur, having your own business, but the rewards really, pay off in the end.
Yeah, that's great that you mentioned that, just the overall impact, and I definitely agree with just overall, as I've been managing large teams on the technology side. You definitely don't experience that reward when it comes to actually helping somebody at the individual basis, especially in your case when you talk about tax saving strategies, or just overall just building out the portfolio and understanding all of the elements that comes across from taxes standpoint, which is a very complex space. And I would imagine the impact is, very tremendous and almost, immediate from that standpoint. So that's very interesting. And when it comes to just maybe paint a picture for us as just a difference between a standard CPA, a tax advisor, and anything that goes along in between, because a lot of us are probably used to hearing, just my CPA, my personal tax accountant who prepares my taxes from just based on the income that I derive. But I understand there's a lot more goes on to when we talk about tax advisor or a tax strategist. Maybe tell us a little bit more from that standpoint.
Yeah, and it's really interesting because there's been researches that's shown that Americans as a whole often overpay in taxes, and overpay meaning paying more than they're legally required to do. And I think one of the biggest reasons we see this issue is that people don't understand that there's a very significant difference between tax return filing and tax planning. So tax return filing is something we all do, even myself, right? That means taking a look at what you did or didn't do last year, and then having your tax preparer put those numbers on the right forms. That's pretty much it. So we're just reporting kind of what happened. And then you get a result, right? This is how much you owe, or this is how much refund you're going to get. There's not much you can do. We hear people say like you can't unring a bell. That's exactly the way it works in the tax world, right? And so tax planning, on the other hand, is forward looking. It's looking at, let's say we're in 2023, we say, okay, what am I planning on doing for the rest of this year? What am I doing for my business? Am I going to grow my business? In what states? What type of income am I getting? If we're talking about real estate, where am I going to invest in? What type of real estate? Long-term, short-term, midterms? And depending on what your plans are for this year, your tax advisor who's helping you with the planning can help guide you through different considerations. So if you do, if you have your rentals in the right legal entity, then maybe you'll get more asset protection and be able to get all the tax benefits, right? Versus if you didn't have in the right entity, then you might, have your assets at risk. And making sure you're tracking the right expenses. So that's where the difference in planning comes in. Planning basically is a way for you to be doing the right things during the year, so that by next April, you're legally able to claim the largest in tax deductions and getting the most in tax savings.
That makes perfect sense. So thank you for clarifying that. And as part of your organization with Keystone, are you providing the full spectrum of those services, or are you focusing on one specific niche when it comes to tax preparation, tax advisory, or planning?
Yeah, that's a great question. So we do have services that do the planning as well as tax return filing, but our focus is really on the planning side. And the reason for that is because that's where we're seeing the most need. I think, as an investor or business owner, you can find people to prepare your returns anywhere, right? If you just look it up on Yelp or Google, there's thousands of people who can help prepare returns. But what a lot of people are missing is the planning part. And that's an unfortunate fact of how kind of the market is, because a lot of CPAs, most CPAs have to invest a tremendous amount of time in doing tax returns, and so the end result is that they might not have the time or the service to offer for clients to do the planning. And that's mostly where people find us, is like, hey, I have someone filing my returns, but they don't offer planning, or they don't specialize in real estate. So I'm looking for help in that aspect of it. So yeah, although we do both return filing and planning, most people come to us initially, at least, for the planning piece of it that they might be missing from their current relationship.
Yeah, it's a funny personal story from what I've been searching all along. I've been investing in real estate for many, many years myself, and now more on the professional side, where we're building out the actual portfolio, and I'm working with a fund where I'm actually, have other investors in my fund and using those funds to invest into much larger projects. So the need for the tax planning has been elevating on my side more and more and more as more complex my investments have gotten. And I've been searching, questions come up all the time. And from preparation and tax planning, it's such a huge difference, it's such a huge need, that to find that right partner to be able to say, here's what we try to do, here's what we're building, what are some of the tax strategies we should definitely explore. So for me, that's it almost feels like an ongoing need that doesn't get quite addressed because of the complexities and so many different moving parts. So that leads me to a question. Let's say you and I are partner up, and I come to Amanda and say, I have this portfolio, but the portfolio is constantly evolving.
Yeah.
Right now we're investing into, let's say, luxury single family residential or maybe multifamily units. But with the fund, we're looking to invest into commercial space or, just a lot different type of a profile of a property. So does that relationship continuously evolve and we constantly review the plans for what we're looking to invest and different strategies to explore? How do you typically structure that? What's the most effective way?
Yeah, for sure. And we do have a lot of clients that are similar to your situation, right? Where you kind of evolve from my own portfolio to now I'm a syndicator, I'm raising funds and going after larger deals. And you're exactly right. There's different levels of complexity. Even if for someone who's done a lot of years of syndication, right? Maybe this year we're doing multifamily in Florida, but next year we're doing multifamily in Ohio. And there's different tax considerations on the structuring side and all that kind of stuff. So, and I think, a lot of people, when you think about taxes, you hear the word taxes, is kind of like, oh no, shy away, right? We don't want to, it's just something not pleasant. But really, if you think about it, if you have the right team, your job as an investor is not to understand all the different tax laws and the intricacies of how to calculate certain things. Your main job is to make sure you have an open line of communication open with your tax advisor, right? So in your scenario, if you're saying, hey, I'm now raising money to go invest in this type of fund, well, it's just an open communication with your tax person. Say, hey, let's chat for 15 minutes next Tuesday about this new fund I'm starting up. And it's in those casual conversations where your tax person will say, okay, well, here's how maybe we should structure it. Are your investors mostly high income? Are your investors going to be using their retirement accounts to invest? Because there's different things that, different opportunities, right, for you as a sponsor or syndicator that might be available. So that's really what it's about. It doesn't have to be something super scary like, John becoming a CPA. It's really just having that open line of communication open. And, how frequently you speak with your tax person is going to be different from person to person. And it'll even differ for you as the investor. So as you're growing your portfolio or launching a fund, you might be talking to your tax person, once a week or a couple times a week. Yeah. But once the portfolio is stabilized or your fund is stabilized, then you might not have to talk to them for 3, 4, 5 months because everything is just going as expected. Right?
Yeah, that makes a lot of sense. And it's interesting because you've mentioned something very critical when it comes to more focusing on surrounding yourself with the right people with the right expertise rather than trying to become that your own expert in the area that you can't just quite become an expert overnight. It's a definite investment. It's a definite, it's very complex. So there's no point of doing that, but really understanding and bringing the right partners into the mix, which I talk a lot about that from a standpoint of every deal that I analyze. Mostly involves, from an attorney perspective, maybe an architect, an engineer, and probably a property manager, and maybe or in the financier as well, someone from the mortgage side who does all the financing. But that from the tax perspective, it's at least from my personal standpoint, it's always been not the most critical. But as I get into more complex deals and I now understand the benefits and the advantages of having that discussion up front, I think that's very crucial and that's very important, which leads me to a further question. When it comes to the actual process of, let's say, a brand new client comes to Keystone and they're saying, Amanda, I have the, small portfolio of properties. Walk us through the steps of how would you, analyze, how would you actually start that relationship with that particular client? And what does that look like at the end of the day when it comes to just executing on the actual strategy that you had advised them on?
Yeah, and I think the answer is the same regardless of whether it's someone that comes to us or another different tax advisor. The planning starts out with looking at what you've done in the past. So like a review of your prior year's tax returns, which entities, what your current structure is, and then also what your plans are in the coming year, right? Year 1 to 3, and then putting together a plan based on what your investment goals are, right? So the tax follows what your investment goals are going to be.
Yeah, and that's, from especially for newer investors, when it comes to understanding those semantics, trying to plan for that way in advance versus trying to play catch up. I think, I've uncovered a lot myself just, running into those problems. Like, for example, opportunity zones. I had never had any idea those things, even existed, or just overall, from the depreciation and the kind of the 1031 exchanges, all of that. I mean, there's just so many different advantages to that. But as new investors, we don't necessarily kind of pay a lot of attention to those things. So when it comes to your personal investment strategies, when you are evaluating a particular investment opportunity, what are some of the initial things that you personally pay attention to when it comes to from tax saving or tax strategy perspective?
Mhm. As an investor, I think one of the main things, I mean, I'm a numbers person. So for me, it just always comes down to the numbers. If the numbers make sense, I don't have to look at the property. I don't feel the need to actually be viewing a property, right? So for me, I'm a very numbers driven person, which I know and not everybody is that way. I think another criteria I like to use a lot, and I always advise investors, is to look at exit strategy. So for me, if I have a deal where there are multiple possible exit strategies or multiple ways that I can create different streams of income, those are very important to me because, one thing as investors, the one thing we cannot control as investors is the market. And so by having multiple different ways to earn income, so this property could be perform well as a short term, but it also will do just fine as a long-term rental is very important to me. Exit strategies like, hey, the worst case scenario, I have no tenant, I'm not able to, I'm not able to cash flow. What are the other alternatives, right? How long can I hold on to the property, or is another exit strategy that I will be able to have a different use for this property? So those are things that are important to me just from a risk minimization perspective to see whether this is a good deal that's for me, right? But again, I think for me, because I'm more numbers driven, probably more on the conservative side in terms of as a real estate investor, that's how I evaluate criteria. When it comes to tax savings, I mean, all types of real estate will provide us with great tax savings. So as long as it's ownership of rental real estate, whether it's long-term, short-term, mid-term, commercial, multifamily, we always get depreciation. So, outside of that, there's not really a huge difference in terms of, what type of property I get into. So I think that people might find this a little bit surprising. So when I evaluate the deal, tax itself is not one of my main criteria. It is one of the criteria I look at, but I never invest in an asset just because of the tax benefits of it. I'm always looking at cash flow appreciation and, the flexibility of that property and what I can use it for.
Yeah, that's very interesting. Thank you for sharing that. When it comes to you working with clients that are maybe more sophisticated when it comes to just overall portfolio construction and maybe newer investors, what are some of the most common, oversights that you observe when it comes to probably most obvious tax saving strategies, but maybe investors are not necessarily considering that? Maybe can you spend a couple of minutes talking about some of those buckets, those areas that, investors should technically, pay attention to when they evaluate an opportunity versus what you see maybe from your line of work that it's not so obvious or not even considered?
Yeah, I mean, I think from a tax perspective, purely, whether it's newer or advanced investors, people are always very confused about like what they can write off. I think it's like, we talk about deductions and writing things off, and people like the concept of it. But at the end of the day, what I always find missing from people is not capturing all the legitimate deductions. So if like I'm investing, I have properties in Florida. So if I flew to Florida, I'm looking at properties, or I'm tending to my current property, the flight, the hotel, the meals, all that is tax deductible. And this is just something that I see time and time again, even with experienced investors who have a lot of portfolio, just not really understanding what they can write off or having a system to track those things. And as an investor, I would say it's probably one of the most important things that you want to be able to do, is whenever you're spending money on something, ask yourself, right, is this something that could be an ordinary and necessary expense for my real estate? If so, make sure you track your receipts or document that somehow so that when it's tax time, your tax person can help you to take a deduction. The reason it's so important is because your tax advisor is not with you all the time. So literally, if you're not documenting the business expenses you're spending, then they don't ever see it, right? So that's just like an opportunity that's lost. I think another common thing that I see, maybe not a missed item, but more of mistakes. Again, newbie to very experienced people is legal entity structuring. I see people from both spectrums, either one where they have no entity structuring at all. So everything is in personal name, there's no asset protection, to people who just have way too many entities. That's just like so much headache and very costly. So definitely, I think from a planning perspective, especially now in the, earlier in the year, in the first quarter, is a really great time to review your entity structuring with your team and really take a look like, is this the ideal structure? Did it work for last year, or was I pulling my hair out because it was just too much? And if it didn't work out well last year, now is the time to get, restructured and reorganized at the beginning of the year, so that for the rest of this year, you have an ideal structure in place for all your investments.
That makes a lot of sense, especially in this current market conditions where, we are experiencing a little bit of a slowdown, a little bit of a cool down, just all across. I think, like you've mentioned, it's probably a great opportunity to clean your books, to revisit the processes, to revisit everything that you have been doing, putting off, because it's been just so crazy and hectic on the acquisition and just overall transactions. I think right now, I like what you said, it's a great opportunity to take a step back and say, here's everything that I have been doing, here's my plans for future. What are some of the things that I'm, necessarily maybe overseeing and making some rudimentary basic mistakes when it comes to tax saving strategies. You've mentioned something interesting on the entity setup space, and I've actually invested quite a bit of resources to work with attorneys when it comes to just the trust formation and the LLCs and other entities. But it's a very new space for me that I'm still trying to uncover and learn a lot. Can you maybe spend a few minutes talking about what are some of the most common misconceptions maybe about LLC? Because I hear that a lot on a daily basis. Oh, I'm just going to register an LLC and I'm going to buy property in an LLC and everything is taken care of. It's a fortress that's going to protect me from everything. But in reality, it seems to be more of a veil rather than some type of a castle. Share some thoughts from that standpoint.
Yeah. Well, for me, from the tax side, I think the biggest misconception on entities, right, is that for some reason, investors are always misunderstood in that they need a legal entity to take tax deduction. So earlier I was saying, I have investments in Florida. I'm going to fly there. I'm going to stay in the hotel there to deal with property stuff. I can deduct that regardless of whether my Florida property is in an LLC or in my individual name, right? And this is true for all types of stuff in the tax world, whether it's like a business or real estate investment. Effectively, the IRS says if you're in the business of real estate investing, in our example, that you can deduct these business expenses. And by business, they don't mean an LLC or a corporation or a partnership. They just mean, you have rental income, right? You're going to generate rental income or real estate commissions, whatever that income happens to be. And so that's, you're saying you've invested a good amount of resources to creating structures, which is great, right? For your level of portfolio, I'm sure it's something that's definitely needed. But for a lot of newer investors, especially like the brand new investor coming out, I always tell them to watch out and don't spend a significant amount of money forming multi-tiered structures. That is maybe super great for someone like Robert Kiyosaki, because you probably don't need that, right? That money is probably better spent on your first deal or your second deal even. So that's how I look at it. But in terms of, once the entities are formed, then really make sure you take the time to understand how it should work. If you have trust and holding companies and baby companies, how does the money flow? How does the money ultimately get to you? Because for you to really get the benefit of asset protection, you have to not just have the entities and put, title in there, you actually be maintaining entities, maintain the entity and operating it correctly, right? So using, the money from the entity bank account to pay for business expenses, and all those good things. But, I mean, sometimes it sounds more complex than it needs to be, but I think with anything in real estate and business, just making sure you understand what you have to do and create a system around that. So for people with multiple entities, an easy thing to do is make sure you have a bank account in the name of that entity. So whenever you're dealing with properties owned in this LLC, you're using that one checking account, one ATM card, one credit card. And so at tax time, it'll be very simple, right? You don't have to try to figure out what property, what entity, and try to unwind that mess.
I love that. It seems so simple, but at the same time, oftentimes overlooked, where we just overcomplicate things when it comes to just simple strategy, simple structure, when it comes to just being able to operate that as an efficient business at the end of the day. I think that makes a lot of sense, and focusing on the simplicity and clarity, that's very important. How do
Yeah.
you personally stay on top of all of the changes and the regulations, especially with different jurisdictions and different states? You've mentioned if you go in California, where you based at, and let's say you consider investment in Florida, maybe share some insights into your content diet when it comes to keeping yourself informed and educated on the ever evolving space of especially taxes.
Yeah, that's a great question. How do I keep updated? It's difficult. I subscribe to all kinds of, tax updates, continuing education stuff, and I have like little cheat sheets for myself to kind of remind me, like, this was the law in 2022, then it changed in partway through 22, or now it's different for 23. So yeah, not only are there a lot of changes, but there are changes happening throughout the year, and little dates and things like that make a huge difference, in our world when it comes to tax planning. But I think, I've been very fortunate in that I have the ability to specialize in a specific industry. In my scenario, it's real estate. So we work with real estate investors nationwide. So for me, just keeping abreast of all the real estate related tax changes and updates, so that I have time to focus on the different states that come into place, which I think which kind of comes back to one of the issues we talked about earlier, where most investors, they have someone preparing their tax returns, but that person might not be specialized or well versed in real estate, because most CPAs aren't as fortunate as we are, where we can specialize in a specific industry. Most CPAs like, oh, I might do tax returns for real estate and food and beverage, manufacturing. So you can imagine it's, very difficult to be kept abreast of all those changes within the tax law. So it's kind of my little unique advantage, I guess, to be blessed to be able to specialize in a niche and just focus in on the changes within this industry, at least.
Yeah, that's definitely an unfair advantage, especially, if you're able to focus on something very specific, as they say, the riches are in the niches. That makes a lot of sense. So who is a tax advisor for someone like you? Or is it you at the point where you're able to keep, all of the things going on in your own space and be your own tax advisor? Or do you have somebody that's actually looks at things from a maybe different perspective? So just curious, how do you structure that?
Yeah, so yeah, my husband and I, we do our own tax returns, obviously.
Mhm.
But I'm, always learning, and I have kind of a Rolodex of other people that are colleagues of mine who specialize in different parts. You mentioned earlier, like trust, right? You have trust in your structure. So fairly well versed myself in trust, but trust in itself is a whole different tax planning segment. And so I have other colleagues that I call on if I have specific trust related issues, whether it's for me or a specific client. And I really believe in this whole concept of collaboration. There are a lot of CPAs, in the US. There are quite a few handful of them that also specialize in real estate too. So I always try to collaborate with other other professionals, because I don't like to be the jack of all trades. Anything that I'm not well versed in, I would like to talk to the expert in that space,
Mhm.
so that I can leverage their knowledge and expertise. So that's kind of how we deal with our own. For things that we don't understand, my husband and I will go out and seek out the advice of other colleagues who have better knowledge in a specific area.
Right, right, right. Yeah, makes a lot of sense. Thank you for sharing that. So last but not least, looking into Amanda's crystal ball as far as current market conditions, and it's a hot topic. It's ongoing. It's everywhere. It's interesting for, even for myself. I study that. I look at different trends, different reports, market analysis. Just from your personal perspective, what are you personally preparing for? Maybe what are you personally investing into? Maybe what are the different opportunities that you're observing, or maybe you're personally very excited about? Or on the other side of the spectrum, maybe you could share something that you're trying to stay away from, or something that you may be thinking that this is not probably the right time to do. So anything that you could share from that perspective would be appreciated.
Yeah, I think, well, first off, I have to say I don't have a crystal ball. My crystal ball is probably worth this, the amount of this pen right here. So I'll take it for what it's worth.
Yeah.
I think having, like I said earlier, we started our firm, we started investing in 2010, which was like, the historical, real estate crash.
Mhm.
Clearly we're nowhere near that. But I will say that in hindsight, my biggest one of I think my biggest regrets is I wish I would have bought more real estate in the
Mhm.
crash, right? I mean, I did buy real estate during that time frame, and so I think going forward, I am just always reminding myself, don't fall into the trap of what the market at large is doing and shying away. In any market, you can find really good real estate deals. In tougher markets, you can find really, really good deals, right? And so it's just being more cautious and spending more time analyzing whether the deal specifically makes sense for you. But for me personally, I'm really optimistic about the market, whichever way the changes will be. We have a lot of clients, including myself, for a while that we've been waiting for the market to cool down so you can once again pick up more real estate, better prices, higher cash flow. So yeah, I'm definitely really excited, excited about what's to come. Obviously, the interest rate changes and the fluctuation has, impacted a lot of investors and being on edge. But I think what will happen is we'll start to see a lot more of the creative financing that we used to see. We haven't seen creative financing deals in many years, mainly because we didn't need to, because bank financing was already so cheap. But I think a lot of these, subject to deals, that type of creative financing, I expect to see a lot more of those.
Yeah, definitely. I share a lot of the sentiment myself because I literally, like I was telling you, pre-recording, just got out of the closing, and I have another one coming up on Friday. And a lot, folks within my circles, within our little South Florida investment club that we have, it's different opinions in terms of what are you doing?
Yeah.
This is a crazy market. You should wait out. Something big is going to happen, things like that. But I've always kind of reverted back, similar to what you were saying, what works best for me, what works best for my personal investment strategy. And that's kind of, I know sometimes it's hard because you hear so much noise and so much information thrown at you, but staying disciplined from that perspective. And what you've mentioned as far as regrets in terms of maybe needing to acquire more when the time was great and there were a lot more opportunities, but also for me kind of exiting some of the properties a lot sooner than I wish I just held on to that. So just having that long-term mentality, I think it's an ongoing muscle that I'm trying to build, but it
Yeah.
definitely resonates with a lot of the things that you're sharing. So I definitely appreciate that. And just overall, Amanda, thank you so much for your time, because you were very generous with your advice, with the information that you shared with us for free. And I'm definitely looking forward to, maybe doing a lot more deeper dive deal analysis with you moving forward. But I'm definitely thankful for your time today. Much appreciated.
Yeah. Thanks for having me, John.